Alright, NBIS is a very interesting growth stock. The agenda for this video is we're going to look a little bit at stock price first here in the intro, talk about the business, and then some of the strong financial numbers that are coming off the back of. We will not be using traditional value investing, and we will not be using the rule of 40 either, since this is not a SaaS. So extremely hard to evaluate, but we can use common sense. And luckily, this happens to be my area of expertise as I'm selling some of the components that NBIS and other managed service providers are using in their data centers. Because this company is a small data center and they're renting out space to other companies for various services. Before we get into that, let's back the tape a little bit. Let's not get ahead of ourselves. First of all, we can see that the company has recently been introduced here to the stock exchange. NBIS Group, listed on the Nasdaq. This data center stock has a market cap of almost 10 billion in this case. So quite large already. And why shouldn't it? This company is riding a macroeconomic trend, and its service is fitting very well into the current business landscape. I'm a bit mad at myself for not looking at companies like this before. It's been right there under my nose. I've seen this for years in the Nordics. How many companies are turning to managed service providers for their IT infrastructure needs? Because in the past we used to have everything on-prem, and you would have one server running one application, and it would be extremely inefficient. Then hypervisors came and it got more efficient on-prem, and then large public cloud providers such as Azure, AWS, and Google Cloud entered the market with a lot of promise. Everything was supposed to go there, and then we saw some repatriation of people bringing stuff back on premise, as the network latency was a bit of an issue for many people, with data centers far away not being able to cover certain high performance use cases. High performance use case. Did someone say AI? Because this is exactly the type of use case that you can't put there. And we have this colo, managed service provider type of business that has just been growing and growing and growing. And we see this in the revenue numbers as well. We see this with a plethora of these type of businesses springing up, especially in the Nordics. Everything from 9 petabyte to hundreds of petabytes of data that they're managing. It's just insane. And profit margins are good, as we will see later on as well. Let's take a look at the business here. Full stack infrastructure for AI. And yes, indeed, they have some high performance infrastructure in their data centers located in, for example, Finland. They have one in Iceland as well, and other locations. How do I know this? Well, I take a look at the roles that they have open, and I see that those related to solutions, architecture, and IT operations are located in, for example, here, this is Finland, data center IT manager, hardware infrastructure, right up my alley. We see this in Israel as well. And if we scroll down, we see, for example, Iceland. Prime locations, already very cold. Iceland, you have the thermal energy in the ground that you can utilize for these extremely power hungry data centers. Makes perfect sense to put a data center there. Finland as well, you have some good amount of nuclear power, and you have also power from the rivers with the water power plants, and you have the cold environment that you can utilize in cooling, so it will not be as expensive. On top of that, they have all flash. If we look at the offerings, we can see that there's no spinning disk. this is of course the GPUs and also some of the processors here. We see both Intel and AMD, and of course NVIDIA. And for storage, we see all SSD. No spinning disk here. And man, for those of you who remember Nearline SAS as well, it would break. So what's the benefit here? Well, they don't need to change disk in the old systems. We talk about RAID, a measurement of how many disks you can lose before you have loss of data. In this case, very modern, very high performance data center. We see this in finance, we see this in AI, and these little cells work completely differently, and you don't need as many system admins that need to switch disks when they break and have hot spares ready and all of these things. But this is very expensive hardware that they have, as we will see in some numbers later on. And then object storage as well. Perhaps I should give these guys a call, so try to sell some good object storage to them, would be nice, you know. And then of course some software stacks as well, because this is a huge operation. They're not only managing the hardware here, they're also managing hypervisor, they're managing detection services. They're doing a ton of things here, and it just makes sense for a lot of companies that are of the SMB, mid-size, even in the corporate segment, to outsource this IT infrastructure to a service provider such as NBIS. It's expensive to have all of these roles here, and there's just so many use cases. I could talk about this for hours, but for the sake of the video, let's move on to look at the profit margins before we look at the revenue growth in this case. I have prepared the profit margin here. We can see in terms of gross margins, they are looking just amazing. And then operating margin, still a big loss. What's the difference? Well, let's say that you're selling a cup of coffee. The cost to make that coffee with the beans, the cup, all of that, that's your gross profit. And then if you add on top of that the salary of the guy selling it and rent of the store and things of that nature, then you have the operating profit. So company not yet profitable. They are bleeding a lot of money, yes indeed, but with the revenue growth that they have, they should be able to go break even and be able to get very profitable, as we've seen these companies become, should nothing unexpected happen. The big challenge here is sales, getting the customers in, because there's a moat around this type of business. Once you're in there, it's a bit painful to migrate your data. For example, I remember a case with a customer who had AWS as their global big cloud provider in that case, and they had some performance issue, and then when they wanted to migrate the data back, they had to pay by the gigabyte, and it got extremely expensive in that case. So that can be a deterrent for many people. Big decision to put your data there, and indeed once the decision is made, they have a moat. So, you know, from an investor perspective, I'm loving this type of business, yes indeed. We also took a look at the balance sheet, but the debt is nothing to worry about in this case. Let's get into the exciting part. Revenues grew 385% quarter over quarter, comparing 2024 to 2025, the same 3 months here. This is in millions of American dollars, so 55 million American dollars in revenue for the quarter. We can compare that once again to the market cap of 9.5 billion, and we see that in terms of price to sales, you're getting a terrible deal. In terms of price to earnings, you're getting a terrible deal. So all the value investors looking at this video is getting very confused now. What is going on in this case? So, but growth companies, they are hard to value, and then, you know, they're gonna complain that the stock price of Palantir is high or the stock price of Tesla or something like this. It's just two different skill sets to value in this case. And we see net loss from the operation. Yes, indeed, quite a substantial loss. We're seeing that the business is expensive to run as well. The cost of revenue here, 29 million for revenue of 55 million. Shows some good gross profit at least. And then product development, quite expensive as well. They could be building certain software models to distribute the data to the way that, they have the consoles for managing the different customers that are utilizing their data centers. There could be a ton of proprietary development going on that can give them an advantage going into the future. We just don't know. And as a hardware guy, when I look at the roles for different coding needed, unfortunately, I don't get a clue. So that's a part for your own research that you need to look into. Indeed, I can only give the hardware perspective and some of the numbers in this case. And then we're seeing sales, general, and administrative. Sales is going to be very expensive in this case. So they had the account executive role out as well. You want to sign that new customer. And in the pricing model, you want them to reserve capacity as well. You can see on the website that they are offering cheaper here if you reserve for at least 3 months in this case, because then it's easier to procure hardware for the customer and make sure that they have enough capacity, enough of the compute, and for provisioning here for 3 months. It just gets easier to manage. If they continue to develop software in some way to make this process easier, handling the volatility, they are taking on a risk and customers are paying NBIS to take on this risk for them, well, then they could be even more profitable from an operations perspective in the future, but only time will tell, and we need to follow the margins closely here. But from a sales perspective, I understand that it's important to pay those salespeople well to get the new customers on board. Once they are on board, they tend to stick. These are long contracts, could be 3 years, could be 5 years, could be 10 years. Lots of money at stake, and we want to pay the salespeople up front, and then the customer in this case is paying for consumption. So it's a pay for what you use type of model. So once they're on board, the revenue is a bit lagging for this type of business. They can't take the revenue and write it up front in this case. They can only realize revenue when they have delivered the service. So they could have signed up a bunch of customers and they can realize the revenue later. And from the change in total amount of revenue that we saw a bit higher here, then this indeed seems to be this case. This is revenue from customers being signed earlier, and it's a bit of a lagging indicator in this case. Very, very important to sell a lot here. A big number here, a big cost here. That's a salesperson that has landed a deal, and the revenue will be realized later. So expecting higher growth as a result of this. This is me speculating, of course, realizing what's the common payment model for salespeople in this industry, an industry I've been in for more than 5 years, and it's gonna be around 10 before I retire. But quite interesting to see. Depreciation, amortization, of course, writing down the value of the hardware that they have in the data center. It tends to be written off on 3 to 5 years in some cases, depending on how much support you buy on the thing. You tend to write it off for that period. 3 and 5 is standard in the industry. And then, of course, total operating costs and expenses are big. They are big. They are losing money. As we saw in the margins, tying it back to the margins, operating margins was minus 50% roughly. Very, very bad right now, and the company needs to grow, which it does, and it grows quickly. it would be very interesting to compare other publicly listed managed service providers to this one as well. I need to make a list and look at some of the competitors in this case. And we also see in terms of the listings here that they have a stake in other companies here, 1010, Avride, Tolka, companies focused on artificial intelligence. My speculation in this case is that some of these smaller companies, they need the infrastructure to develop their business model, their AI model, the software that they're trying to sell, and they don't have that much cash up front. So they make sort of a deal with NBIS that NBIS gets equity and they get to utilize their infrastructure. So you're getting some interesting bets as well when you buy a company like NBIS. We've seen this with, for example, OpenAI and Microsoft, where OpenAI gets to utilize the hardware infrastructure from Microsoft, and Microsoft gets a stake in OpenAI. So those who owns the shovels in the gold rush always makes money. I think that's an old saying that I'm paraphrasing, but in this case, very, very interesting company. We're seeing a high valuation already from a value investor perspective, but from a growth investor perspective, this is a exciting company. Let me know your opinion on this company down in the comments below, especially if you have some coding experience. We can take a look at some of the roles here. I will scroll really quickly, and you can pause and see if you recognize some of the code requirements that they are listing in this case. Some of the software side of things, C++, Track to AI, CloudGate. There's a few, and UX researcher. So there's a few of the code and software related aspects that could use some clarifying in this case, but I hope that the hardware related clarification gave you a ton of value today. Alright, that's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now. Bye bye.